Hello, everybody. How's everybody doing today? Rates are down. The Fed has cut rates. Let's go. I'm just going to start this slideshow up. Ooh. Let's get squared away here. The Fed cut rates today. Rates are cut. So I'm not doing a 2-minute pause or anything like that because I want to get right into it because this is such a important topic, right? And this is such an exciting time. So and I actually made a lot of posts. I'm just pulling up some of these posts on Facebook and stuff like that. Some of the comments that I've gotten on my commentary on the subject. I've gotten a lot of different hate for saying that, simply saying that rates have been cut by 50 basis points. Just from posting that, I've gotten a lot of hate. There's a lot of animosity out there. But I just want to remind everybody that the reason I do these videos, the reason that we research these topics is because we want to learn, we want to get better, and we want all the people around us to get better. We want to network with more people. And really, we just want to do good business with good people. We're not trying to fight. We're not trying to argue. Healthy argument and discussion is great, but we don't think we know it all, and we're excited to learn from people. But not everybody knows everything. Nobody knows everything, in fact. And typically, best performance is achieved through collaboration, right? So we are looking to collaborate. This is the reason that I do these videos, and let's get right into it. So I was going to put somebody on blast a little bit, but I decided not to. So we're not going to do that. But I might pull up a couple comments just so that we can go over some of the misconceptions about how much power the Fed has and some of those things, right? So I'm going to go into just a little bit of the comments just so we can see some of the misconceptions that people have about Fed rates, right? And how much they impact the market and how much control the Fed actually has. Because in fact, the Fed doesn't have as much control as it would like, unfortunately. And the broader market really has a lot of different dynamics that affect rates and things like that. So did the mortgage market already have this priced in? So that's the argument that I've been getting a lot, right? That the mortgage market already had this priced in. Rate drops and loan originators were already leveraging the recent rate drops to work with clients. So there was proactive market participants is the argument, right? So proactive banks, proactive loan originators went out and they already priced in these rate drops, right? I'm going to get into, that does have an impact, but I'm going to get into more of why that's not 100% the case, right? So I've got some people that are loan originators that are arguing with me and stuff like that. And I'm not here to say that I know more than you, but I'm here to look at what's going on and to realize that this is a very complex situation. So we're going to get in. This is from the average surveys from Freddie Mac, which I understand the universal mortgage-backed security is a bundle between Freddie Mac and Fannie Mae now, and that happened in 2018. But mortgage rates and the Fed's funds rate, they do go together still, right? So if we, there's a lot of different things to go over. So I'm going to get right into it. So that's why I didn't do the roller coaster ride like I typically do. So rates were lower last week than they are right now, right? Even though the Fed dropped rates by 50 basis points. So yes, the Fed does not have control like they would wish. The Fed doesn't have full control over the market. It's very dynamic. This doesn't mean rates aren't going to continue to go down. So market sentiment and investor behavior, mortgage rates, and other long-term investment rates are driven by bond market activity than the Fed short-term rate cuts. After a Fed rate cut, if investors expect inflation to increase, or if they believe the economy is stabilizing and risk is lower, they might start selling bonds. As bond prices fall, yields which influence mortgage rates, rise. So even though the Fed cuts rates, market forces push long-term rates higher, right? So inflation expectations, if there's inflation expectations that the Fed move too fast, there might be a sell-off in the bond market. So supply and demand and risk premiums, lagging effects of rate cuts, like there's a lot of different things that impact your rate sheet that you're going to get from the bank tomorrow, right? One second. So I also want to highlight another feature because people are like, oh, rates were lower last week than they are this week. That does not mean that rates aren't going to keep going down, okay? That's because people were selling off bonds. So the supply of bonds went up, right? Because demand went down, because maybe people moved money into equity markets. Maybe people bought, yen and they did a carry trade on it. Like there's so much going on, right? So what is a carry trade? And this does have an impact on what's happening. So a carry trade involves borrowing in a currency with low interest rates. So like if you have Japanese yen, you can borrow in yen and buy US dollars and get the VIG on the interest rate changes, right? So if bond yields start rising after the Fed cut, it's likely because investors may have sold off US bonds to seek better returns elsewhere. This selling pushes bond prices down. And since bonds move inversely to bond prices, yields go up even after the Fed cuts rates. If investors anticipated further rate cuts, they may have shifted to riskier assets like stocks, triggering the bond market sell-off. So if we look over today, let me just hop out of this real quick. Oh, let me share this tab instead. So let's look at the market right now, okay? 1 second. The market is up a lot, right? I started this presentation with showing the screen, and the market is up. There's a lot of money going into equities right now. So do you think that maybe there was a sell-off in bonds and some of that money went into equities, therefore you have a higher mortgage rate that you're getting quoted today? But does that mean that it's going to stay that way? No, it does not. Okay. So I just want to show that real quick. Now let's go back over to so basically you have a risk appetite shift. So following a rate cut, there's often a shift in risk appetite. A Fed cut could signal more stimulus or a looser monetary policy, which might make investors move out of safer assets like bonds and into riskier, higher returning assets like equities or high yield bonds. This exodus from government bonds results in a sell-off, driving yields higher. Number 4, bond market sell-off. The Fed's decision to cut rates by 50 basis points can also signal that they see trouble ahead in the economy. Some investors may have interpreted the move as the Fed anticipated a more significant slowdown or recession. This perception can lead to a bond market sell-off, as investors may feel less confident in holding long-term bonds in a potentially turbulent economic environment. A sell-off would cause bond prices to fall, pushing yields, interest rates higher. The market may also have believed that the Fed's move wasn't enough to counteract negative forces in the economy, adding to concerns. But why would they invest in equities then? Global influences. Global factors like the strength of other economies, geopolitical tensions, and the performance of major markets like Europe and China can also drive U.S. bond yields higher. If global investors perceive more attractive investment opportunities elsewhere, they might sell U.S. bonds, increasing yields. Number 6, maturity and duration. Another factor to consider is the maturity of the bonds being affected. Longer-term bonds, example, 10-year treasuries, tend to respond more to inflation expectations and long-term economic forecasts, whereas shorter-term bonds react more directly to Fed rate cuts. So even if the Fed cuts short-term rates, long-term bond yields can still rise if inflation fears or growth concerns increase. Now, let's get to the point where we think if that's going to happen or not, okay? So I just wanted to go over this really fast because there was a lot of comments on some of the posts I've made about how, oh, the rate's actually higher than it was after the Fed cut rates. So yeah, it is. Okay. That's normal. Okay. So we got through that. Now, let's go over to, I just want to show you one more slide. So this is the British pound, right? This is another thing. The British pound rose by 0.26%, right? So there was a lot of movement in the British pound. And we even have one economist from Fidelity saying, I think it's more likely the Fed cuts too much and the economy accelerates, Royal London head of multi-asset Trevor Greenham said. It might be that there are not loads of global rate cuts, he said, adding he expected higher market volatility from here. I see more turbulence. There are just too many risks. So people are scared, right? Investors are scared, and people are moving their money around depending on what happens. Some people think that the Fed cutting rates is going to restart inflation, right? But let's talk about what the Fed's fund rate actually does, because to understand all of this, we have to understand that. What does the Fed's fund rate do? The Fed basis rate or federal funds rate. One second. Let me just show myself here because I clip reels from this. So let me just get on here. So what does the Fed's fund rate do? The Fed basis rate or federal funds rate is the interest rate at which banks lend reserves to each other overnight to meet reserve requirements. This short-term lending is crucial for maintaining liquidity in the banking system. The federal funds rate directly influences other short-term interest rates, such as those for consumer loans, credit cards, and adjustable rate mortgages. When the Fed raises or lowers the basis rate, it affects the cost of borrowing for banks, which is then passed on to consumers and businesses, shaping overall economic activity. Now, that doesn't mean there isn't a lag. So basically, if you're a bank, right, if you own a bank and your operation costs are lower now, and banking is competitive, if banking is competitive in a market, then you would have to compete with other banks. So if your operation costs go down, then you have to maybe get better rates over time. There might be a short-term arbitrage where you can get away with jacking rates a little bit and making the VIG. Maybe you can boost your balance sheet up because they're not in the best shape. But, that's not going to maintain because it's a very competitive industry. So let me go back to my slide here. Federal funds target rate. Now, every time the Fed, this is another common thing that people talk about, is the Fed's fund rate directly tied to like recessions? Does the Fed only start dropping rates when they see like a black cloud and it's too late? So they start dropping rates aggressively, but we're already in a recession by then, right? That's a lot of people think that. And if we look at this chart from 2000 to now, I mean, it kind of shows that. I'm very parched. So if you look at 2000, after the dot-com bust, the rates were about 6%. The Fed's fund rate was about 6%. And they started dropping rates significantly. Now, you also had the S&L crisis going on through the 90s, and this didn't wrap up until early 2000s, right? You had the Resolution Trust Company selling these bad assets on the S&L balance sheet all the way up until early 2000s. So the dot-com bubble is this chart, right? That's the recession that we went into from 2000. So we went from 6% all the way down to a super low rate. And then we jacked it back up, and that triggered the '08 recession, right? Well, it wasn't really that triggered the '08 recession. It was all the lending practices that the lenders were doing and things like that. And a lot of that started in the '80s. But we don't have enough time. Watch my other videos. So you can see here that there's a recession after rate cuts typically. And the theory is that, yeah, the Fed has the best windows into the house of the economy, and they're able to see things on the horizon that normal people can't, or even sophisticated investors can't. So they start dropping rates rapidly. One of the things that happened in recent months is there's been massive jobs revisions, right? There's been massive data revisions. A lot of the data was being played with. So now the Fed, a lot of people are surmising that the Fed is playing catch up. So is the Fed playing catch up? That's the big question. I think they probably are. For me, I think they probably are. And if anyone tells you they can predict the market, they are lying. So nobody can predict the market. Nobody. Now, a lot of people, not a lot of people, some people have been able to get better returns than the market. But 95% of asset managers, 95% of stock brokers, all that stuff, they underperform the market. Okay. So it's a very select few who actually outperform the market. Now, is the Fed playing catch up? So no one can really predict the market. Is my point. But is the Fed playing catch up? Um, so we had the BLS job revisions. We had 800,000 jobs being revised down over the year, and um, a lot of different CPI data has been coming out. I was expecting a 25 basis point cut. So a 50 basis point cut was pretty surprising to me. To me, that does seem like they are scared, right? That the economy is a little bit worse than they thought, and they're making quick moves. Okay, so that's just my thought, and I'm not a licensed professional in any category. I am not a licensed professional. I'm not a lawyer. I'm not an accountant. None of that. So just for disclosure. So Jerome Powell, though, in his recent meeting, when he addressed the nation, saying that we were going to cut by 50 basis points, talked about housing a lot because the CPI in August actually went up by 0.2%. So CPI, was kind of a little bit higher than what we wanted it to be. And they still cut rates by 50 basis points. But one of the reasons that the CPI was higher is that shelter costs still aren't going down like the Fed wants them to. So housing costs, rent, all that stuff, it's not going down the way the Fed wants it to. So when a reporter asked Jerome Powell about this issue, he said, I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. Powell said it's hard to zone lots that are in places where people want to live. All of the aspects of housing are more and more difficult. And where are we going to get that supply? And this is not something that the Fed can really fix. So the Fed said, Jerome Powell came out and said, like, the Fed cannot fix housing. This is a local issue. This is a local political issue. And housing is not going to be going down anytime soon. So any hiccups in the market is your opportunity to buy, is my perspective. And like I said, I'm not a licensed professional in any category. So Jerome Powell said yesterday that he can't fix housing. That's more of a local issue. So what does that mean? In my last live, we talked a lot about land restrictions and how hard it is to build, how hard it is to maintain properties, and how you can't build when regulation is too heavy because it's too expensive. So supply is never going to be there. And that's what Jerome Powell was talking about here. When you have land restrictions on housing and when you have zoning laws and all these super high building standards, you're not going to be able to get affordable housing built. Simple as that. Let's move on. So I also wanted to talk about how maybe the stock market reacts to some of these interest rate cuts. So we talked about all the different market dynamics that are at play here. We talked about how, if the Fed cuts rates, maybe people think that inflation is going to happen again, and that is a bad signal for actual economic conditions. And maybe people will think that, now that the Fed is cutting rates, it's going to accelerate the economy again, and they're going to be forced to cut rapidly like they have in the past. And economic activity is going to pick up, so equities will perform really well. There's a lot of different things, and that's why I said at the beginning of this video, we're not here to act like we know it all. We're here to try to figure out what's going on. And the more I post about these things, the more I learn. And the more people call me out and the more people argue with me, and it makes me better. So it's good. But this is a chart of the S&P index, the interest rates overlaid. And as you can see here, this chart, let me just maximize this screen. So this part, this is, what the hell? This is the wrong chart. No, never mind. Yes. Okay. So right here is our interest rates. And this is the S&P index, how it's performed. So when the Fed started dropping rates in 2000 after the dot-com crash, the S&P index went down. We were in a recession for almost 2 years straight. And then in 2003, when rates were at their bottom, the economy started to pick back up. And then you see the same thing happen in 07, in 08. And then you see the same thing happen in 2019. So I could see why people think that. Now, there's also been a ton of outflows of some of the equity market in recent history. So, according to Goldman Sachs, this guy's firm's broker and custodian, outflows from U.S. equities have been 58 billion. Inflows to money markets is 707 billion, and huge inflows into bonds and new non-U.S. international stocks. So, before today, in like a week, there's been a lot of money going into bonds because there's so much risk in the global market that people don't know what's going to happen. So they're buying US Treasury bonds because it's a very safe bet. Back in August, there was the yen carry trade that blew up. Japan raised their basis rate by 25 basis points, and there was a massive there was a massive inflow of capital into the bond market, and rates actually went down by 0.6% back then. So there's been a lot of money going into the bond market and coming out of equities. A lot of the stock market ups have been from the market concentration in the Magnificent Seven or Six or whatever it is. But like I said, I've said this in other videos. It's not about this short-term information. You can spend your whole life trying to figure out, what is going on in the day. That information does not serve you well. The best information are long enduring facts and decision-making parameters that allow you to become a better decision maker. So do not focus on, oh, this is going on over here, this is over here, this is over here. You need to have like decision-making parameters. And that's why most asset managers underperform the market. So this is federal government expenditures. On top of the land restrictions that Jerome Powell talked about in his address yesterday, I think that the amount of money the government is spending and the way the government is growing, it is not going to stop. So this is current U.S. government expenditures. So as you can see here in the beginning of 1950 is when this started, and we have went way off the charts, right? And during COVID, we went way off the charts. But we're basically at this point where our interest on our debt is compounding, and our deficit is just growing and growing and growing, and the government is just expanding. So the BLS revisions that were down were not government jobs. In fact, government jobs were revised up. Oh, skipped a slide. One of the things that Milton Friedman said, which Milton Friedman was a leading economist back in the 80s, and while we had the 70s inflation problems, Milton Friedman was an outspoken economist that was widely listened to. So one of his famous quotes is, "Inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than an output." Milton Friedman. So when the government prints more money and they don't increase productivity, that causes inflation. That's very true. I think there's a lot of market dynamics, but that's pretty simply put. When you have more money in the system and there's not more production going on or output, that money is just stagnant and it's looking for assets to buy, which causes inflation, is what Milton Friedman is kind of saying here. And I have this chart. If you look at the median home price the last 30 years, it's risen with government expenditures as well as everything else. So what is the summary of this presentation? Buy good deals. I think that even if we go into a recession, even if the market gets a little bit hectic, if you can buy a good deal today, in 2 years it will be a really good deal. Like Jerome Powell said in yesterday. Let me pull that back up. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging, Powell said. It's hard to zone lots that are in places where people want to live. All of the aspects of housing are more and more difficult. And where are we going to get that supply? And this is not something that the Fed can really fix. So, like Jerome Powell is pointing it out right here. Housing's not going to go down. And we're going through a period of economic instability, high risk, and people demanding, better returns. And there's so much money printing going on. It's ridiculous. So when you have money printing, assets with intrinsic value go up. Good businesses, food, shelter, water, commodities, they go up. And when you can't build, you can't increase the supply. When it's really hard to build, you can't increase the supply. So since 08, a lot of the great builders went bankrupt, right? And there was no building all the way up from this time. From 08 up to like 2016 is when people started building again. And at one point in my life, I went through all the different reports of the permits pulled, the starts and stops and completions throughout the last 30 years. But I don't have a photographic memory, I guess. So I don't remember that off the top of my head. But I will say that we haven't been building like we should have. We had a lot of building going on when rates were super low. So a lot of starts happened in 2020, and they are currently hitting the market. So this is also putting supply into the housing market. A lot of these buildings that were built were targeted at $75,000 plus annual earning households. So a lot of the projects that were built were like luxury housing or higher class housing. They're built down south in Florida, in Texas, in high tech centers. Like a lot of the housing was targeted towards people that were making good money. And so that's where you're going to have your completions, right? So real estate is so localized. That's another piece you have to remember is you have the overall market and then you have your local market. And even in 08, there were local markets that were doing really well. So your local market might boom, whereas the market at whole isn't really doing too well. Now, broad market dynamics do impact your local market as well, and it makes it much harder to get credit, to get loans, all that type of stuff. But my theory is that housing is going to go up, and it's going to go through the roof. I mean, I think we're at the start of our new business cycle again, and the only risk is that inflation comes back around, which if you look at this, so basically all the risks that are out there, right, are going to benefit housing too. So one of the major risks from cutting rates is that inflation picks back up. If inflation picks back up, it directly correlates with housing. Like literally housing is one of the most inflationary things, especially when you have these supply and demand dynamics. So, well, right now anyway, I don't know if it's been like that throughout history, but right now that's certainly true. And housing is going to go up. So the things that would impact housing prices are like credit restrictions. So people can't get loans, interest rates are high, because you're using 80% leverage, it's going to be harder to buy a house. It's going to be more expensive to buy a house. So now that the Fed has started dropping rates, which we talked a lot about how rates are actually higher today, rates are going to come down over time, I believe, because your real return is there. And even if banks are temporarily, charging a little bit more, and you had a lot of proactive loan originators, it's going to start coming down because the economy, like U.S. market, is still the best market. So there's demand for U.S. Treasury bonds. It's just we just had this outflow of capital, right? So the UK, there's so many things going on. So that's why we all have to look at all the different things. But I believe housing will go up. If it goes down in the next 6 months, that's fine. In the next 2 years, it's going to be so expensive. It's going to be very hard for people to afford it, and there will be outcries on housing. And what happens is, like, they'll probably come out with some stimulus program. I mean, they're already talking about $25,000 first-time home buyer grants. And that'll make housing more expensive. So, but you have to look at history. I'm not just like saying that. I'm looking at history. When they came out with the FHA after the Great Depression to stimulate the economy, when the VA started becoming popular, when Section 8 kicked in, these all made housing more expensive. So government stimulation in the housing sector causes housing pricing to go up, pretty much always. So I would surmise that you should buy a good deal. I'm not going to surmise anything. You should buy good deals. And that's why at the end of this slide, I have my last piece of advice. Buy good deals today, and tomorrow there's still going to be good deals. And in a few years from now, you're going to be like, wow, I can't believe how expensive housing is my perspective. So thank you guys for joining me today. And I hope you have a great night. I'll talk to you soon.